let's see what we have to say.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. Reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4 to 4.25%,
which was expected,
and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Chris.
Great. Thank you. Chris.
I'm actually pausing the questions for a second. What is happening with the mortgage rates right now, the 10-year Treasury, is it's gone up a little bit. So it's exactly what I've been saying all this time, that when they come out and they say they're only cutting 1/4%, not 0.5%, that it's already expected, it's already baked in. So the 10-year Treasury has gone from close to 4.0 up to 4.05. It's not a huge move, but it is a move where rates are kind of going up a little bit here. So if he would have come in saying being more aggressive as far as cutting rates over time, that dot plot, then we may have seen rates drop, or if they would have said a 50 basis point, which is 0.5% cut, then you would have seen rates start to drop, but that's not what happened. So let's go to the questions and answers.
About the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when we feel that policy is a place and needs to move quickly to place. That's not at all fate, and see.
That's the answer I wanted. Sorry, y'all. I'm just going to refresh the page altogether.
And I think we can
kind of be in place. I guess I'm just, trying to square the shift in the rate forecast in the SEP to
So what he was talking about was
towards more cuts than just 3 months ago, with the fact that
that employment has now taken a hit, so their fears of inflation have kind of taken a back seat, and that the inflation is more shorter term as opposed to longer term, the inflation due to tariffs, that is, and the pricing adjustments we've seen are because of that. But we've also seen a reduction in demand, a reduction in spending and buying. Therefore, like, exporters are taking on some of that risk or some of that payment, as opposed to it all being on the consumers, so we're not seeing the inflation hit that hard either. And a 0.25% drop probably each of the next couple meetings, and some meetings next year, but they're going to take it slow. Of course, if unemployment goes up further, then they'll probably accelerate that or add some more cuts in the mix.
forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth next actually ticked up just as
All right, well, thank you all for watching. I'm going to go ahead and end it because we're having way too many difficulties with their website and this live stream. But thank you all for stopping in.